Welcome to this webinar on double insurance and contribution. My name is Adrian Kwintner. I'm a senior associate in Manchester's insurance team. My co-presenter, Burnett, is a principal associate in the insurance team across Manchester and Leeds. This session is being recorded, and whilst you can see us, we can't see you. Hopefully there'll be time for questions at the end. So please do post in the chat box as we go along. These will be presented by my colleague Harriet Strevens at the end. Otherwise, we will respond by email. So moving on to the first slide. Double insurance and contribution between co-insurers go hand in hand. I'm going to talk about double insurance and Liam will talk about contribution. The principles of double insurance are set out in Section 32 of the Marine Insurance Act 1906. Double insurance occurs where policies from at least two insurers cover the same interest in the same subject matter against the same risk and are taken out by or on behalf of the same insured. Double insurance occurs when you have these four elements, as shown on the slide. So how does double insurance work? Other than express conditions, you can insure with as many insurers as you like, up to the full amount of your interest with each policy. And you can seek recovery from one or more insurers up to the full amount of your loss. But once the total loss has been recovered, you can't claim against any other policies. However, if double insurance exists, the insurer who pays out has an equitable right to pursue co-insurers for a contribution. Double insurance is different to primary and excess layers, as there needs to be an overlap or duplication of insurance. The concept can be broken down, as I say, into these four elements shown on the slide, and each of them must exist for there to be double insurance. So moving on to the next slide, what is the same subject matter? In property insurance, this means the same tangible or intangible property. There does not seem to be a direct English authority on whether policies must be on identical property or whether it is enough for a sufficient part of the property to be insured elsewhere. In the 1910 case, American Surety and Wrightson, a bank employee misappropriated some money. The loss was paid by American insurers who covered employee dishonesty. They claimed a contribution from a Lloyd's underwriter who covered the same loss, but also embezzlement by others, fire, theft, and robbery. It was conceded that as both policies covered employee dishonesty, there was the same subject matter, even though the Lloyd's policy was far wider. In liability insurance, the same subject matter means both policies must cover the same insured against the actual loss or liability. Now let's look at same risk. At least a substantial part of the same risk must be covered by both policies. The overlap must be for longer than a brief period. Locality may also play a part. For example, in BOAG versus economic insurance, a company owned two factories and insured cigarettes loaded at factory A under an all-risk transit policy. The cigarettes were transported to factory B overnight, where they were destroyed by fire. The insurers paid out, but could not get a contribution from other insurers who had insured stock at factory B, but not stock temporarily at factory B, whilst in transit from factory A. The risks were different and the criteria for double insurance weren't met. Just moving on to the next slide, let's look at same interest. The insured's interest in the subject matter must be the same. So where two people, such as a landlord and a tenant, each insures its own interest only in the same property, there is no double insurance. But if the tenant also insures its landlord's interest, this could mean double insurance if the landlord can bring a direct claim under the tenant's policy, whether as a party to that policy or under the Contracts Rights of Third Parties Act 1999. In a case dating back to 1877, North British and London, harbour masters had fire insurance on property where they were the bailees. A client's grain was destroyed by fire while in the harbour master's possession. The client also had its own insurance covering the grain against fire. The harbour master's insurers paid out, but could not get a contribution from the client's insurers, as the interests were different. One was the harbour master's interest as bailees, and the other was the client's interest as owner. Same interest also means both policies must be enforced at the same time. So if there's a premium payment clause and the premium hasn't been paid, then the policy isn't in force and there is no double insurance. The fourth element is the same insured. The same person must be able to benefit from at least part of both policies. Moving on to the next slide, how does anyone know that double insurance exists in the first place? Many policies contain clauses requiring disclosure of other policies covering the same subject matter, whether they are an issue at the time or come into play later on. The clause may also require obtaining the insurer's consent. So the clause could be construed as a condition entitling the insurer to avoid liability if the clause isn't complied with. Some policies also contain conditions whereby you have to, whereby you can't have any other policy, whether at the time or later on, covering the same property. The insurer could waive that condition expressed against double insurance, for example, by giving prior written consent, or if it accepts a renewal premium where it knows about another policy. Policies can also include other clauses relating to contribution and the level of contribution. Liam's now going to talk about contribution and how those clauses work.
Thanks, Adrian. Okay, so having established that there is double insurance and with another insurer on the scene, the paying insurer wants to know if it can claim a contribution. Now, the first thing to note here is that the claim for contribution arises or is rooted in equity or arises through operation of law. So it must be brought in the insurer's own name. That's very different to claims that are brought in contract or under subrogated rights, which are brought in the policyholder's name. And that can't happen here because the policyholder, having already made a claim and having obtained an indemnity from one insurer under one policy, can't then bring a claim to another policy because its losses have been made whole. And that's why a subrogated claim must fail. So how is the proportion of the contribution calculated? Well, the common law starting position is that insurers shall be liable for the proportion of the amount that they're each liable to pay to their policyholder under their own contract. However, insurers will often insert terms that limit or exclude their liability where there is double insurance. And these terms are often referred to as other insurance clauses, and they exist to exclude or limit or avoid entirely insurer's liability to meet a claim for contribution. So what do other insurance clauses look like? Well, taking exclusion clauses first, and there are two main types, escape clauses seek to exclude all loss that's covered under another policy. Excess clauses seek to make their policy an excess cover. So in effect, that policy is postponed and only triggered once all other insurance policies have been exhausted. Now, this is very different to layering of cover, where different policies are obtained with different insurers, in relation to different levels of risk. Let's just examine for a second exclusion clauses in a little more detail. What happens, for instance, where one policy contains an exclusion clause but the other doesn't? Well, that's fairly straightforward, because the policy that doesn't contain a clause will respond in full to the loss. The policy that contains the exclusion clause excludes liability, or it will cover is postponed because it becomes an excess cover. It doesn't respond, there's no double insurance, and therefore there can't be a claim for contribution. What happens if both policies contain exclusion clauses? Well, in that scenario, the clauses are ignored. They cancel each other out. And absent any other relevant clauses, each insurer is liable for the entire loss, but because there's double insurance, the liability is shared. And this is to avoid both exclusions applying and the policyholder being left with no cover at all. Rateable proportion clauses seek to limit the insurer's liability to a proportion of the loss. That means that where there is double insurance, the insured can't recover all of its loss from one particular insurer. Recovery from each liable insurer is proportionate to their relevant share for which they're liable for under their contract. And having effective rateable proportion clauses in multiple policies doesn't exclude the right to claim a contribution. However, the paying insurer needs to take care that it doesn't overpay the claim, either on an ex gratia basis or as a volunteer, because that might mean the insurer that faces then the claim for contribution could raise as a defence the fact that the paying insurer has waived its right to claim a contribution. So how do we determine the proportions under a rateable proportion clause? Well, just to make it clear, I'm not going to talk today about contribution under the average clause, which is a session in itself, and it's outside the scope of today's discussion. However, generally speaking, insurers are liable for their rateable proportion. And there are two methods for calculating this. The maximum liability approach usually applies to property insurances, where the contribution is calculated by reference to the sum insured. So where the sum insured is the same in both policies, the insurers are liable equally. However, where the sum insured is different, insurers are liable and will bear liability for the amount that their policy bears to the total loss. I'm just going to explore that in an example for a second. If insurer A gives cover for 10,000 and insurer B provides cover for 20,000, then in that scenario, insurer A will be liable for 1/3 loss and insurer B will be liable for 2/3. The next approach is the independent liability approach, and this applies in liability policies where each insurer's liability is worked out independently. Let's look at that in an example. Insurer A covers up to £100,000 and insurer B provides cover for £10,000. What happens if the loss is 5,000? Well, because each insurer is separately liable for the whole sum, the liability will be shared equally. However, if the claim, the loss, is £20,000, then because insurer A is liable for the full sum, but insurer B is only liable for half, then the proportion will be split 2/3 insurer A, 1/3 insurer B. What happens where the insurer has a defence to their policyholder's claim for payment? Does that amount to a defence to a claim for contribution? Well, the law isn't settled and there are conflicting authorities, but the strong view that's expressed by McGillivray is that where there's a claim for contribution and both insurers are liable at the point the loss occurs, then the contribution should be, so they should each bear contribution in their proportionate shares in accordance with the rateable proportion. So let's just think about that. Where the defence to payment occurs before the loss occurs, and that might arise where there's a breach of the duty to give fair presentation prior to inception. It might also arise if a warranty hasn't been complied with, so there's a breach and it hasn't been cured. In that example, the breach occurs before the loss arises, and McGillivray says that the insurer there ought to have a defence to pay a claim for contribution, and that's because there is no insurance under that policy. However, if the defence arises after the loss occurs, so for example, it's a late notification and therefore the policy doesn't respond, McGillivray says that, in his view, that should not amount to a defence to defeat a claim for contribution. And because these claims are brought in equity, that seems a logical and fair response. In conclusion, in broad terms, the first question is always, is there double insurance? And where there is double insurance, the starting point is that both policies respond in their proportionate shares unless they say otherwise. However, it's highly unusual for policies to remain silent on contribution where there are other insurance clauses. And as a rule of thumb, where there are such clauses, just to bear in mind that exclusion clauses trump every other clause. And under English law, there's no distinction between an escape or an excess clause. Exclusion clauses on both sides cancel each other out, and rateable proportion clauses operate whether they appear in one policy or in all policies that respond to the loss. So that's it from us on this subject today. I'm now going to hand over to Harriet to take any questions.
Thanks very much, Liam. We have a couple of questions that have come in, and given the subject matter, you can reasonably understand they're quite lengthy. But first off, I think perhaps Adrian would answer this for me. Do you see the concept of double insurance as being an issue or problem?
No, not of itself, but it can lead to insurers arguing whether they need to pay out at all, which can cause delays to the claims handling process, and also in turn cause difficulties for the insured. I mean, in the long term, so as long as you can insure against the same risk with more than one insurer, double insurance is here to stay. So insurers, or many of them, will want to incorporate some of the clauses that we've talked about today. I mean, a practical issue is that you just might not know whether another policy exists. So, for example, if you're locked in settlement negotiations and you're trying to conclude a deal with a settlement agreement, it's just something to think about. The insured might not even know whether another policy exists, although the policy may have a clause saying that you need to disclose other policies on the same subject matter, and the insured will know that it has other policies, but it might not realise that another policy has or does cover the same subject matter. I mean, one other point or issue is that I mean, I do think there's a real problem with how courts interpret double insurance. The law just isn't clear, and so there would be it would be welcome to have some clarification on that.
I would agree with you there indeed, Adrian, and I think Liam probably has a view on that. Liam, what is it that interests you particularly about the concept of double insurance, and do you see, or can you see, how the interpretation of the contribution might evolve further?
I think it's a really interesting and detailed area. I think there are two areas maybe where the law might develop. The first is where an insurer has a defence to the payment of a claim by its policyholder. Does that amount to a defence to a later claim for contribution? And I've discussed that, and McGillivray gives a fairly strong view that it matters when the loss arises, and if the insurers were liable to indemnify the policyholder at that point, then they ought to contribute in their rateable proportions. And that seems fair, and these claims are rooted in equity, and it's logical. I think the other area is that, just to address the fact that these clauses, or the other insurance clauses, are non-standard. So they can say different things, and they may appear in policies that contain different jurisdiction clauses, and the approaches of courts in different jurisdictions are different. So I can see maybe the law evolves into a place where it's looking at the contractual construction and what the clauses say and what they mean, and being more prepared potentially to weigh them against one another to see which one wins. There was a case last year, it was an Australian case, Allianz Australia and various underwriters at Lloyd's, and that was looking at which clause won, and it was the competing clauses. One was an escape clause, the other was an excess clause, so both exclusion clauses, but the court took the view at first instance that the escape clause excluded all liability, so that policy didn't respond at all, whereas the excess clause made that policy an excess cover. And so because there was no cover at all as a result of the exclusion under policy A, the excess clause meant that, well, there was nothing else, so there was no other insurance, and that excess policy became the policy, and so it responded. And that, in that case, the escape clause won, but then that was reversed by the Court of Appeal. So we are where we are, and in English law, exclusion clauses, you know, they rank equally, they cancel each other out, they appear on opposite sides, and there's no distinction between escape and excess clauses.
Well, thank you, Liam. It's a very detailed answer. We have many more questions, which unfortunately we don't have time to answer. So I will pass this back to you to conclude on the basis that those that you can answer by email will be dealt with in that way. Thank you, Liam.
Thanks, Harry. Well, thank you for everyone for joining today. We are around. If anybody has any questions by email, please do get in touch with us, and please do contact us on LinkedIn. When we close this session, there will be a feedback form for you to complete. It'd be really grateful if you could do that. Just let's have your comments on how we did today. If you want us to talk to you offline, privately, or in a different forum about the content of this discussion, then please do say. We'll look at that. Also, if you could let us know what other subjects that you might want us to talk about, so we can consider that. Just a reminder that next week's session we have Aaron Matthews talking about Brexit and the impact on the insurance sector, and that will take place at the same time on the 26th of November. And please sign up for that. And apart from that, thank you very much for joining.